Welcome to The Explainer. Today, we are going to decode a single number that can literally make or break a company. And that number, it's called the cost of capital. You ever just stop and wonder, how do the great companies actually get great? I mean, how do they decide, yep, let's launch that brand new product, or let's build that massive new factory, or, let's expand into a whole new country? Now, on the surface, it seems incredibly complex, right? But believe it or not, for any company, it really all boils down to their ability to answer one simple but absolutely crucial question. And that question is this new idea worth the cost? Think about it. Every single big bet, every innovation, every single expansion, it all requires money. And that money, it is never, ever free. All right, so let's really dive into this. We're calling this the billion-dollar question, and for good reason, because that's literally what's at stake sometimes. You've got companies with a dozen amazing ideas, but only enough cash for maybe a few of them. So how on earth do they choose? Well, the answer, the key, really, the tool they use to make these massive decisions, it all lies in one single incredibly powerful number: the cost of capital. So what exactly is it? Okay, simply put, the cost of capital is the rate of return that the folks who provide the money, we're talking lenders and owners, require as compensation for taking a risk on the company. The easiest way to think about it, it's the company's financial hurdle rate. Any new project has to literally jump over this hurdle to even be considered. Okay, so how do you actually calculate this magic number? Well, it's kind of like a recipe, actually, and the most common one out there is called WACC. So let's take a look at what goes into it. WACC. It stands for Weighted Average Cost of Capital. Yeah, I know, it sounds super complicated, but don't worry. It's really just a fancy way of saying it's a blend of all the different costs of money a company uses, all rolled into one single number, one percentage. So, to really get WACC, you just need to know the two main ingredients in this funding recipe. First up, you've got equity. That's money from the owners. And second, you've got debt. That's just borrowed money. The WACC is just a reflection of that company's specific mix. So in this example, you can see it's 70% from owners and 30% from borrowing. Simple as that. Now you have to understand, these two ingredients are very different. Debt, for example, is lower risk for the person lending the money, so they're okay with a lower return. But here's the kicker, the really crucial point. The interest a company pays on its debt is tax deductible. The source material actually calls this a tax shield, which is a great way to think about it, because it makes debt even cheaper. Now, equity, on the other hand, is much riskier for the owners, so you better believe they demand a higher return. And for the company, no tax break on that. So when you boil it all down, getting to that final WACC number is really just a three-step process. Step one, you figure out the after-tax cost of debt. Remember that tax shield? That's key. Step two, you determine the cost of equity. And step three, you just blend them together based on whatever the company's financing mix is. That's it. That's the core idea. All right, so we've got the recipe. Now for the fun part. Let's see how a company actually uses this number to make the right call day in and day out. The source material has this great quote that puts it perfectly, but let me just translate it into plain English for you. It basically says you should keep investing in new projects right up until the point where the return you get from your very next project is exactly the same as what it cost to fund it. To put it another way, you stop when you're no longer making a profit over that hurdle rate we talked about. And check this out. This is a perfect illustration of a go decision. Let's just say our company's WACC, that's our hurdle rate, remember, is 10%. Okay, so we've got two potential projects on the table. Project A, it's expected to return 20%, and Project B is looking at 15%. Both are way above that 10% hurdle. These are what you call green light projects. It's a no-brainer. You do them. But what about these projects? We've got the same company, the same 10% hurdle rate, but this time Project C is only projected to return 8%, and Project D, just 5%. See how both of those fall short of the hurdle? Pursuing these would be a huge mistake. These are your red light projects. The WACC gives you a clear, disciplined, unemotional no. And this all brings us to the ultimate consequence of making these decisions. Because really, it's not just about picking good projects or avoiding bad ones. It's about something much more fundamental. It's about answering the question, is the company actually creating value, or is it destroying it? Okay, let's just run a super quick scenario here. Imagine a new project comes along and it's expected to return 15%.
And let's say the company's WACC, the cost to get that project off the ground, is 10%.
So what's the result? Simple. Value created. That 5% spread right there, that's pure value being generated for the company and for its owners. All right, now let's flip it around. Imagine a different project comes up. This one has an expected return of only 7%. But the company's WACC, remember, is still 10%. What's the outcome this time? Value destroyed. It's that simple and that brutal. By investing in something that returns less than the money cost to fund it, the company is literally, actively making itself poorer. So, why does any of this matter to you? I mean, really. Because this cost of capital thing, it isn't just some boring number on a spreadsheet. It is the bright, shining line between creating wealth and destroying it. It tells you if a company is strategically disciplined or if it's just chasing growth for the sake of growth. And at the end of the day, it's the key that helps you understand if a company's big, flashy new bet is actually going to pay off. So from now on, the next time you see a company announce some huge acquisition or a bold new venture, you'll be able to ask the most important question of all. Is it clearing the hurdle? Are they actually creating real value, or are they just making a lot of noise? You now have the framework to start figuring out the answer for yourself.